Hello everybody, welcome back to another video. We'll be doing a DCF model on Target. So we'll be looking at Target stock today and we're gonna go ahead and see what this bad boy's worth. So we'll just jump right into kind of what we need to discuss here. Of course, like any DCF model, we essentially need to know our revenue growth rate that we want over the time period we're looking at, and a free cash flow margin that we can apply to those projected revenues so that we can then get projected free cash flows into the future. Now, average analyst has Target growing at about a 3.6%, and then the following year, 4.5%. So, I mean, here's my big concern with Target. You have to assume all possibilities. And let's assume the possibility that we go into a recession. Well, let's be honest. While Target is a much better, in my opinion, shopping experience than, let's say, like a Walmart, which is just a friggin' frenzy, people are willing to pay more for even a lot of what is the same exact name brand products. They're willing to pay more because Target's a better shopping experience. However, when a recession comes on and there's more constraints put on your average, person, your average Joe Schmo that's just trying to shop for groceries, they may not want to go to Target. When people are tight on money and cost of living keeps going up and housing and everything, and if you throw a recession in the mix and people start losing their jobs, if there is a recession, do you really think that people are going to continue to shop at Target versus a cheaper alternative? Now, don't get me wrong, back in our last recession around 2008, Target, basically almost went bankrupt, and they came back from the brink of death. I think they've built enough of a brand where you don't really have to worry about that. But at the same time, you may lose some revenue growth if we go into a recession, because it really is more expensive. I think everyone can acknowledge that. People are willing to shop there and pay a little extra for the better shopping experience. We've got the same thing here in basically in the South in Florida with Publix. Let's be honest, Publix is more expensive than your average grocery store, if we're being honest, but people pay there. People pay a little extra, a little more for a better shopping experience versus having to go to like a super Walmart or neighborhood Walmart where the shoppers are just animals. Okay, anyways, so, they're not even really estimating all that great of growth, 3.6% followed by 4.5%. Who knows what'll happen in the last 3 years? So in terms of this model, I think 3% is a pretty good number to go with. It's obviously going to be lower than the analyst by a reasonable amount because, first of all, we want to be conservative on our models. But not only that, there is risk to Target's top line. There's risk to the revenue growth that we can expect, especially with rising cost and if we go into a recession. Okay, so we also need to apply a free cash flow margin to these projected revenues. So we need to figure out a free cash flow margin that makes sense. Now, I actually looked at the last 5 years in their free cash flow margins, and it's kind of all over the place. You've got a 4.8%, 8.4%, 5.2%, 3.3%, and then a 6%. So, here's the thing. That's kind of all over the place. Those average out all 5 of those years to 5.5% on average. We're never going to go with the average on a conservative model, and considering the fact that you never know what will happen to a company's margins, like this, it's very retail based. I think a very fair margin is to just go down 1%. We'll go with 4.5%. I like that. 4.5% is only higher than one of those years, which in 2019 was a 3.3% free cash flow margin, but at the same time, 4.5% is under the other 4 years. So I like it, 4.5%. Okay, so all that's left to do is we're going to go ahead and run the model now. But before we do that, if you are not already, make sure you sub to the channel. It's going to help you keep up to date on all my content and my videos that I post. So if you like the content, make sure you sub to the channel. And if you like these kind of videos, and this video in particular, make sure you like the video, give it a thumbs up. It supposedly helps the algorithm, so go ahead and help spread the love with this video and give it a thumbs up. Okay, with that, let's go ahead and get into this model. Okay, join me on the screen here. We grow the revenues out by that 3% that we agreed on out to the year 2027, and that'll bring it to 122.8 billion. We also apply our free cash flow margin of 4.5%. By the way, I'm sorry, I forgot to change the years for the free cash flow section here. This should read all the way out to the year 2027. It does not. Once that free cash flow margin of 4.5% is applied to all projected revenues, we then need to find a terminal value, which will be based on the last year projected free cash flow. We can get that terminal value by applying a weighted average cost of capital. In this model, I use 7%. You can get that from finbox.com. After that, we need to apply our discount rate, the rate of return that we want on the company. I like using 12%. After all those values are discounted, we can then add those values up. We then divide by shares outstanding, and you get an intrinsic value of 194.45, or we'll just call it about 194 a share. Okay, everyone, so $194 a share. The current share price is about $220 for Target, so according to the model, it's a little overvalued. Oh boy, I'm going to get all the Target goers a little angry here. Okay, but all jokes aside, yeah, according to the model, it is a little overvalued. I mean, not terribly overvalued. When I ran the model, I was actually a little surprised to see that the fair value based on 3% revenue growth was going to be even, around 200. But yeah, not terribly overvalued. But again, I mean, according to the model, it's definitely not a buy. Of course, you can run your own model and apply your own numbers if for some reason you think that Target's, bursting at the seams, ready to grow at 5+% revenue growth over the next 5 years. It could certainly change the model and put it in fair territory or even undervalued. But remember, we want to be considerate on these models of being conservative. There is a lot of sense in being conservative. And yeah, so according to the model, Target is currently a little overvalued. Okay, y'all, let me know down below in the comments your thoughts on Target stock. Do you too feel that it's a little overvalued as this model suggests? Honestly, I had bought Target, oh my God. I had bought it when the whole COVID crash first started, and it was like around $100 a share. I didn't buy that many shares, but boy, I feel dumb, I guess, for selling. Like, I should have held. I made some money. I sold around 150, which obviously, at my 100 cost basis, it's a great value based on cost basis. So let me know your thoughts down below. I think if you own Target and you have it at a low enough cost basis where you bought at a good time, I mean, it makes all the sense in the world to just keep the stock. It's a relatively stable stock. I believe they do give a dividend, correct? But if you're looking at Target to buy now, I mean, I personally feel that it's a little overvalued, and according to the model, it is overvalued. So let me know your thoughts down below on Target stock. And that's all I've got for y'all. So thanks for watching. I'll see you in the next one.